You know what's funny? So many people think that moving abroad makes their taxes disappear. But here's the truth. It doesn't erase them, like it's multiplied them. If you are a seven-figure earner thinking about living part of the year overseas, running a business from Bali, or investing through your Hong Kong company, you are still playing by the same US tax rules. And the IRS, they are everywhere. So in this video, we are breaking down how high-income Americans can live, invest, and operate globally without triggering double taxation, losing compliance, or getting that dreaded IRS letter in the mail. So here's the roadmap so you can follow along. So part one is going to be the 2026 global tax landscape, what changed and what matters for you. Part two, residency rules, how the IRS decides whether you have already left, you are really left the US. Part three, structuring global income, how to set up your business investment in real estate so you don't overpay. Part four, some client story from people just like you. Part five, the compliance framework, filing that protects your global wealth. Part six, building your global family office, how to coordinate it all like the top 1%. And stay until the end because I will share one bonus timing strategy that can save tens of thousands of dollars, something almost every global owner misses. Let's start with the big picture. So go to part one. So in 2026, the rules for global owners are tightened, smarter, and more connected than ever. The IRS and FinCEN now share information with almost every major financial center in the world. So if you have income or accounts abroad, you are visible, period. Here's what's important to know right now. For 2025 tax year, the foreign earned income exclusion sit at 130K. So it's short for FEIE. The 2026 number will increase slightly, but let's be clear, that's nothing for a seven-figure earner. It's helpful, but it's not a game changer. The foreign housing exclusion adds roughly about 30K of extra benefits depending on where you live, especially in high-cost cities like London, Singapore, or Tokyo. And the real heavy hitter, the foreign tax credit FTC, the dollar-for-dollar offset that prevents double taxation. Let's put a face to this. Ms. Mark from Austin, Texas, he expanded his software firm into Spain last year. Suddenly, he was paid 25% tax in Spain and still own US tax on the same profits. He was frustrated. Here's what we did. 1. We classified part of his income as salary under FEIE. 2. Claim foreign tax credit for the rest. 3. Sync everything under FATCA and Form 8939 to stay compliant. By the time his 2025 filing was done, his US tax bill dropped from 46% to 26%. Nothing offshore, nothing shady, just structure. So if you are expanding globally, remember that location doesn't save you, structure does. Let's move on to part two. We want to understand residency, so the line between abroad and non-resident. This is where a lot of people trip up. You can live in Paris, work remotely, and still owe full US tax because for the IRS living abroad doesn't always mean non-resident. Here's how it works. To qualify for a foreign earned income exclusion is the FEIC that we mentioned above. You have two paths. One is the physical presence test, which means you must be outside the US for 330 full days in a 12-month period. Or 2, the bona fide resident test, where you establish a real tax home abroad and prove you are living there indefinitely. But even then, as a U.S. citizen, you are still taxed on worldwide income. Hello, that's how they get you. The only way to truly become a non-resident is to treating tiebreakers or renouncing citizenship, and that's a huge step. Here's some example for you. Tina from San Francisco moved to Portugal in 2025. She spent 10 months there, but she kept her home in California for the registration, and she still ran her U.S. venture fund. When she filed her 2025 taxes, the IRS said you never left. So here how we fixed it for 26. First, Tina changed her legal residency and home base to Lisbon. 2. Set up a Portuguese tax ID. 3. Started paying local taxes. 4. Shifted her broad meeting overseas. Now she qualified for both the FEIE and foreign tax credit, all while staying compliant. The lesson here is not about where your suitcase lands, but it's about where your control lies. Next up, we talk about where most high earners lose the most money, structuring global income. So let's move into part 3, structure your global income streams. Let's break this into 3 different buckets. You have active income, investment income, and real estate income. So first, active income. Meet Evelyn from New York. She moved to Singapore to lead her consulting firm in 2025. Here's what we help her to do. 1. Form an LLC, a Singapore company. 2. Pay herself $120,000 salary, fully covered by FEIE. 3. Left the rest of her profit taxed at Singapore 17% corporate rate. 4. Structure ownership to avoid triggering control foreign corporation or CFC rules under U.S. law. 5 forms 5471 and 8938 for full transparency. The outcome? Evelyn cut her total global tax rate from 41% to 23% legally and cleanly. Second, investment income example. So Ben from Miami had a $3 million foreign ETF portfolio. Here's the problem. Foreign ETFs are often PFICs, and PFIC are tax rated. They convert your long-term capital gain into ordinary income and stack on interest penalties. Here's the fix we use. Swap foreign ETF for US-based version with the same holdings. Spread PFIC liquidations across 2 years. File Form 8621 for proper disclosure. Result, same market exposure, 40K less in taxes and no IRS headache. Third, let's look at real estate income. So Julia from Seattle owns rental in London. Instead of buying them in her own name, she used a UK limited company. So here's the setup. 1. The UK company collected rent and paid local taxes. 2. Julia reported everything under FATCA and FBAR. 3. Claimed foreign tax credit on her US tax return. 4. Used seasonal and housing exclusion for part of her time managing the rentals abroad. Every property was fully disclosed, compliant, and tax efficient. Let's pause here. We have covered structure for your business, your investment, and your property. But here's the truth. All of that collapses if your compliance isn't airtight. So let's move on to part 4, the 2026 compliance framework. This part is the difference between peace of mind and panic. If you make 7 figures and operate globally, these are the 6 non-negotiables you have to file every year. First is FBAR, which is FinCEN Form 114 filed. Your foreign account exceeds 10K at any time. 2 is FATCA, so Form 8938. 5 if your specified foreign asset exceeds 200K for single and 400K for joint. 3 for Form 5471, 8865, and 8858 for ownership in foreign corporations, partnerships, or disregarded entities. 4. You need to file Form 8621 for PFICs, that most foreign investment funds. 5. Section 988 reporting for currency gains and losses on international transactions. 6. Form 8833 for claiming treaty benefits for tiebreaker status. So let's give you an example. David from Los Angeles moved to London in 2025 and opened several foreign accounts, but didn't file FBARs. So that's $10K per account per year and potential penalties. So here what we did. 1. File the missing FBAR through delinquent submission procedure. 2. Added a reasonable cost statement explaining how he corrected it. 3. Updated his 8938 and 5471 filings for 2025. Result: no penalties, no audit, just a fresh start in 2026. So remember, compliance isn't optional, as you are proof that you are playing the game right. Now let's move to what comes after compliance coordination. So Part 5, beyond 2026, building global family offices. When you're well crossed borders, your system should too. At this level, you don't just need a CPA, you need a structure that connects your U.S. advisor, foreign entities, and investment into one ecosystem. So Tax Sophia from Honolulu, after selling her tax company in 2025, she had assets in 3 continents. So stock in the U.S., operation in Singapore, and real estate in London. We helped her set up a family office that was like a global control center. So one, a U.S. LLC for domestic assets. 2, a Singapore entity for Asian management. 3, a London office overseeing European holdings. 4, a single dashboard to track income reports and compliance filings worldwide. 5, quarterly strategy session to adjust for new tax law. It wasn't about hiding wealth, it was about coordination. Sophia didn't escape the system, she built her own inside it. And that's what the wealthiest global owners do. They don't trade loopholes, they design systems that make the rules work for them. Now let's come to our bonus timing strategy that almost nobody uses, but every global owner should. If you like the video so far, like, share, subscribe, and especially share it with somebody you care. Let's move on to part 6, the bonus tip, the hidden power of timing. Let's talk about one of the simplest but most overlooked tools in global tax strategy, timing your foreign tax credit. Here is Liam from Chicago. He consulted for a Dubai company. So his foreign taxes for 2025 wasn't due until February 2026, which meant he couldn't claim them in his 2025 tax return. Under IRC Section 905A, we elected to claim those credits in the year they were paid, not when the income was earned. The timing change served Liam nearly $28K in U.S. taxes for 26. Here's why it matters. It's not always about where you pay tax, but when. Getting the timing right, let your credit works in your favor instead of expiring unused. So if you are earning globally, coordinate your payments and elections before December 31st. Don't wait until your CPA is filing in April. So let's wrap it up. We started with why moving abroad doesn't make your U.S. taxes disappear. It just makes them more complicated. We walked through how residency rules define your tax home. We build strategies for active income, investment, and real estate. We covered compliance, family offices, and that hidden timing bonus that can save you thousands. Going global isn't about escaping the system, it's about mastering it. When you combine smart structure, perfect compliance, and strategic timing, you are not avoiding taxes, you are controlling them. The IRS wants data, you want freedom. And in 2026 and beyond, the one who wins are those who build both a compliant borderless wealth engine that earns anywhere and report everywhere. That's how $1 million earners live, move, and thrive not by running from the system, but by designing what works on both sides of the ocean. Mahalo for watching. I will see you at the next video update.